Welcome back to Iron Financial, the only place you need to forge a stronger portfolio and really cut through all that market noise. Today, we are putting a pandemic-era giant right under the microscope, DocuSign. All right, Alex, let's get right to it. DocuSign, to me, that name is just synonymous with 2020. I mean, I was signing apartment leases from my couch, closing deals over Zoom. It was the absolute king of remote work. But, the world's moved on. So I think the question for our viewers is really simple. Is this stock just a relic, a fading memory of the lockdown era? That's the billion-dollar question, Ben, and it is exactly what the bears are whispering in the market. But what if the market is missing the real story here? What if the foundation they built during that chaotic period is now being used to construct something far, far bigger, something powered by AI? We've torn apart their latest earnings report, and believe me, the blueprints for their next chapter, they're right there in the numbers.
Okay, so this is the absolute core of the debate, right? The story out there is that as people go back to the office, that urgent, desperate need for e-signatures just fades. And DocuSign's growth just stalls out. It becomes a utility, not a growth engine. I've heard from a lot of our subscribers who are asking this exact question. Alex, is this a one-hit wonder? Is that whole narrative wrong?
The narrative isn't just wrong. It's like looking in the rearview mirror while you're trying to win a race. The market is absolutely obsessed with the past. But DocuSign just dropped a financial report that tells a completely different story. And it's not a story about clinging to what worked in 2020. It's a story about a calculated, aggressive pivot into a whole new arena. And the best part? They're funding it with the fortress of a balance sheet they built over the last 5 years.
All right, let's get into the details, because this matters. Look, their foundation is rock solid. You don't get 95% of the Fortune 500 as customers by being some flash in the pan. That's a deep, wide moat around their business. They are deeply, deeply embedded in the workflows of the world's most important companies. Okay, that's fair. Enterprise clients are sticky. I'll give you that. Ripping out a tool like DocuSign is a major institutional headache. So the core business is stable. But we're not here to talk about stable, Alex. This is Iron Financial. We're here to talk about growth. So where is this dramatic reinvention you're talking about? It's buried in the numbers, Ben, and that's what we're going to break down for you right now. You have to understand, this isn't just some quarterly report. It's a roadmap. It shows a company that is quietly but methodically transforming itself while everyone else is still thinking about the past.
So let's look at the report card. This is where we separate the hype from the reality. These numbers you're about to see are more than just a strong finish to the year. They are the fuel for a much, much bigger ambition. They show a company that isn't just maintaining its core e-signature business, but is actively using the cash from it to fund a massive new venture right under our noses. This is the heavy lifting that builds empires.
All right, I want to see the proof. A lot of companies talk a big game about transformation and AI and all the buzzwords. The numbers, however, they don't lie. So let's drill down.
The headline here is incredibly simple. They didn't just meet Wall Street's expectations, they shattered them. We're talking revenue, profits, future outlooks. On every single key metric that matters, DocuSign surpassed the forecasts. That kind of decisive overperformance, especially in this tough economic climate, it forces you to stop and ask one simple question. What is really going on under the hood here?
An earnings beat is always good to see, I'll grant you that. But a single beat can be an anomaly. I need to see the components. Let's see the raw power. Show me the top line.
Here you go. Top-line revenue. They brought in nearly $837 million in a single quarter, and that's up a solid 8% year over year. Now, Ben, I know what you're thinking. In the world of high-flying tech, 8% doesn't exactly sound like hypergrowth.
Exactly. It's solid, but it's not spectacular. It's not the kind of number that makes you jump out of your chair and hit the buy button. Frankly, it looks like that utility business we were just talking about. Steady, predictable, maybe a little boring.
And that's the mistake so many people are making. For a company with a multi-billion-dollar revenue base, 8% is not boring, it's powerful, consistent growth. It's the engine of a freight train, not a sports car. This isn't some startup trying to find its footing, it's an established leader. This number proves the foundation is not just stable, it's still expanding.
But here's where the story gets much more interesting. It's not just about what they make, it's about what they keep. Take a look at the profitability. Adjusted earnings per share hit $1.01. The street was looking for 95 cents. Okay, a 6-cent beat on EPS. That's a clear sign of efficiency. It means their margins are better than anyone anticipated. They're controlling costs, managing the business well. That's good operational discipline. But my question is it just shrewd cost-cutting, or is there something else driving this higher profitability? It's both. And that's the point. They are running the core business like a well-oiled machine, and it's generating a ton of cash. This isn't some company burning money hand over fist for growth. It's a cash flow fortress. And that incredible efficiency is what gives them the firepower to invest in their next act without taking on debt or diluting shareholders. This is what true financial strength looks like.
Now we get to what I believe is the most important number on this entire report, billings. For the first time in the company's history, they crossed $1 billion in billings in a single quarter. That's up 10% year over year.
Okay, Alex, you got to break this down for everyone watching. Revenue is what they earned this quarter. We get that. What exactly are billings, and why do you see this as the critical metric?
It's a great question, Ben. Think of billings as a preview of future revenue. It's the total value of all the invoices sent out to customers for new contracts and for renewals during the quarter. Now, that money hasn't all been recognized as revenue yet, but it will be over the life of those contracts. So billings tell you the direction the business is heading. Seeing billings growth at 10% actually accelerating past revenue growth, it shows that the sales pipeline is not just healthy, it's gaining serious momentum. Demand is building.
So this table, it just sums it all up perfectly. You've got the forecast on the left, reality on the right, a clear beat on revenue, a decisive beat on earnings per share. DocuSign is outperforming on all fronts, period.
The numbers are solid, Alex. I'll absolutely grant you that. The company is financially stronger than many people seem to give it credit for. But this doesn't feel like a reinvention story yet. This feels like a very well-managed, mature tech company. This financial strength is a launch pad, as you said. So it's time to talk about the why behind these numbers. Where are they aiming this rocket?
This brings us to the absolute core of their reinvention. This strong financial performance isn't a victory lap for the e-signature business. No, DocuSign is using that cash to bet its entire future on a brand new category, one that is powered by AI. This is the moment where they stop being just a tool and start becoming a platform.
All right, now we're getting to it. This is the part I'm skeptical about. I mean, let's be honest, a lot of companies are just slapping the AI label on everything these days. I want to know if this is real foundational innovation or if it's just marketing fluff.
It's called Intelligent Agreement Management, or IAM. And no, this isn't just an upgrade. It's a whole new operating system for how businesses handle contracts.
Okay, Intelligent Agreement Management, it's a mouthful. Translate that into plain English for me. And for everyone at home, what problem does this solve for a business that a simple e-signature doesn't?
Okay, imagine you're a big company with tens of thousands of contracts, right? IAM is the AI that helps you draft that contract using pre-approved, compliant clauses. It helps manage the whole back-and-forth negotiation process, gets it signed, and then, and this is the crucial part, it analyzes the contract after it's signed. It automatically flags key renewal dates, it identifies non-standard or risky clauses you might have missed, and it can even aggregate data across all your agreements to find opportunities for cost savings. It turns a static PDF that's filed away in some forgotten folder into a dynamic, queryable asset.
This analogy right here on the screen, it just nails it. For the last decade, DocuSign was the digital pen. It was an essential tool, no doubt, but it was one you only used at the very, very end of a long and complicated process. Right, it's a feature. A very successful, very profitable feature, I'll admit, but a feature nonetheless. Exactly. With IM, they are building the entire smart office around that pen. They're not just the pen anymore. They're the desk you write on, the software you use to draft the document, and the AI analyst who reads it for you when you're done. It's a fundamental shift from being a single-use tool to being an indispensable end-to-end platform. And that is how you build a much deeper, much stickier relationship with your customers.
Okay, the vision sounds compelling, I get it. But vision doesn't pay the bills. How is this new strategy actually performing? Is anyone really buying it? Let's look at the adoption rate. Let's see the proof. Let's do it. So just over a year ago, at the end of fiscal year 2025, this new IAM platform made up only 2.3% of the company's annual recurring revenue, or ARR. And as you know, ARR is the most important metric for a subscription business. It's that predictable income they can count on. So a year ago, IAM was a tiny, almost experimental slice of the entire business.
Whoa. Okay, now look at this. Fast forward just 1 year. That is a huge jump.
That tiny slice has absolutely exploded. IAM now accounts for nearly 11% of DocuSign's total annual recurring revenue. Ben, to go from 2% to almost 11% of your entire business in just 12 months, that's staggering. This isn't just growth. This is a massive validation from the market that this new vision is exactly what their customers want.
I have to admit, that's incredibly impressive. That's not a gradual adoption curve. That's a vertical leap. It's gone from being a rounding error to a major pillar of the business in the span of a single year. That completely changes the growth narrative for this company.
And let's put a hard dollar figure on that percentage, just to show the sheer scale of what we're talking about. The CEO confirmed on the earnings call that IAM products are already generating over $350 million in annual recurring revenue. So this is a third of $1 billion business that for all intents and purposes didn't exist 2 years ago. That's the kind of internal startup growth you rarely, if ever, see from a company of this size. Okay, Alex, I'm convinced. This isn't a theoretical pivot anymore. This is a rapidly growing cash-generating business line.
Exactly. The strategy is working, and the numbers are proving it out. But how confident is the company itself? You know, as they say, talk is cheap. Let's look at where management is putting their own capital, because their actions reveal everything about their conviction in this new direction.
Okay, this is where the rubber meets the road. I want to see if they are just talking about this new future or if they are truly betting the house on it.
Look at this number, $2.6 billion. That's the total amount DocuSign has now authorized to buy back its own stock after they injected a fresh $2 billion into the program.
Wow. A share buyback of this magnitude is one of the strongest signals a company can possibly send to the market. It's a statement of profound confidence.
It's more than a statement, it's an act of extreme conviction. Management is effectively shouting from the rooftops, we've looked at all possible investments, and we believe the most undervalued asset we can buy right now with the highest potential for future returns is our own stock. They believe the market doesn't understand the IM story yet, and they're buying up shares before everyone else catches on.
And here's the former CFO confirming it directly. She explicitly links their robust free cash flow, that's the pure cash profit generated by the business, to this massive buyback. This isn't some kind of financial engineering with debt. This is them taking the actual profits from their strong core business and reinvesting it in themselves. So the message to the market is loud and clear. We are so confident in our AI pivot and our future growth that we believe the best investment on Earth is ourselves. That's an incredibly powerful signal to send.
And this confidence is also reflected right here in their official forecast for the coming year. They're guiding for total revenue to approach $3.5 billion.
So even with all of the talk about a tough macro environment, they are projecting continued steady growth. They are not hunkering down and bracing for impact.
Not at all. These are not the numbers of a company that's playing defense or preparing for a slowdown. These are the numbers of a company that is on the offense, expecting the momentum from their new AI-powered platform to continue driving the entire business forward.
So let's pull all of this together and frame the final verdict. DocuSign is not the signature company you remember from 2020. That business is just the foundation now. They are using their massive customer base, their trusted brand, and their fortress balance sheet as a launchpad for something much bigger, much smarter, and frankly, much more lucrative.
It's a classic business strategy, really. You build an impenetrable moat with one product, and then you use that secure position to launch an entirely new, higher-margin business from a position of strength.
This slide right here captures the entire story in one simple image. It's the shift from the digital pen, which is a tool used at the very end of a process, to the AI-powered platform, a system that manages the entire life cycle of an agreement from creation to analysis.
It's the difference between selling a product and selling a solution. One is a simple transaction. The other is an entire ecosystem. And that, right there, is the core of DocuSign's reinvention, and the entire thesis for any long-term investor looking at this stock.
So here's the final verdict from our analysis. First, the idea that this is just a pandemic stock is dead wrong. The financials are a fortress, consistently beating expectations. Second, they are executing a massive and so far highly successful strategic pivot into AI and data with their IM platform.
And third, that new platform isn't just some science project. It's growing at an explosive rate, already contributing over $1/3 billion in recurring revenue. And finally, the company is backing this pivot with billions of their own dollars, signaling immense self-confidence in the future.
Which leaves us with the final question for your portfolio. DocuSign mastered the art of the signature and built a durable, lasting empire. Now it's betting that its new AI brain can unlock the trillions of dollars of value hidden inside every contract on the planet. The risk, of course, is execution. This is a massive transition. The question is, can they successfully evolve from a company that finishes agreements to one that powers them from start to finish? That's the multi-billion-dollar bet they're making right now, and it's what will ultimately determine if this is an opportunity or a trap. The foundation is ironclad, but that new skyscraper is still under construction. Thanks for joining us on Iron Financial. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.